Thanks for taking some time to learn about true diversification. We see true diversification as really being the umbrella term, name of the program, really encompassing different intellectual property and technology touch points like diversification optimization, diversification visualization, measurement, search, as well as our proprietary analytics and prediction technologies. Thank you again, and feel free to visit our site more for additional presentations. Diversification used to be easy. Models produced by G-Sphere tend to look a bit like an endowment model, and Harvard's endowment is one of the biggest and one of the best. For those of you that have read, one of Swenson's books, it's basically the same type of approach, and they didn't really know they were optimizing for diversification, but their portfolios basically ended up looking a lot like that. So it's an interesting data point to kind of track how those different models have changed over the years. Point in fact, to see how easy it used to be, look at Harvard's endowment's asset allocation in 1982. All right, 2/3 stocks, 1/3 bond. Okay, job's done, and worked great for the university. But as the years has gone by, markets not just have increased in volatility, but also in these giant ups and downs, which volatility doesn't really do a good job of capturing. And in fact, it's a lot worse than just being more volatile because it's less predictable. It's actually unpredictable volatility. And as this came more and more prominent into the market, you can see how these allocations have shifted. Here, so 66% stock, and now between U.S. and international, we're 48%. Now we're down to 30%, circa 2004. Now we're at 33% into 2010. So they're needing to diversify more and more away from stocks. With the hardest thing to diversify out of is the stock market, and the closest thing to that is like the S&P 500, it's S&P 500 is typically the worst thing you can invest in from a diversification perspective. You think it owns 500 things, it's greatly diversified. Well, no. It's adding concentration risk to the one thing that you can't diversify out of the most, which is systemic risk. So by introducing these other sources, more alternatives, more real assets, private equity, bonds, there's more sources of diversification that are more likely to stand up during those black swan type of crisis events. The importance of diversification really is channeled through risk. And again, risk, when I say the word risk, I don't mean volatility. When I say volatility, I mean volatility. When I say risk, I mean risk. And risk here is losing money. So if we lose 10%, it takes an 11% return to get back to even. If we lose 50%, I need a 100% return to get back to even. That offsetting 50% return to lose 50% and then make 50%, that's going to leave me at 75% of my initial investment, down 25% from where I started. And you can see the worse the loss, the greater the return necessary to protect your money and get back to even. So, those black swan events that take things down and are more than just kind of a stationary volatility blip in the market that we see all the time day to day, but true bear markets that are chewing up capital. It's incredibly important to protect against those. So you have more money left to participate in the next upward compounding cycle, whether it lasts 1 or 2 days or 1 or 2 years. So from a calculation perspective, we see a few different things. One is we see all these different assets interrelate to another. So all these blue assets that are going in the 10, 11 o'clock zone, those are assets that are going principally the same direction. They're highly correlated to each other. Once we take all these assets and we combine them, we put this frame around the portfolio. We call it the efficient frame. Basically, it's like a 3D efficient frontier, except instead of being relativistic, like an efficient frontier in a Markowitz fashion, 2D, this is holistic. So it shows how do all these assets interrelate and what's the sum of the whole. So in this sense, we see assets that have a relatively more unique space in that portfolio, geometrically, are going to be better sources of diversification in that portfolio. And other assets that are part of the pack here, they might still belong in the portfolio, but chances are not in the same percentages. And that's how we end up putting assets in proportion to their diversification. So this image that we create and impose on the right side really gives us a clear understanding of that balance that achieves in any portfolio. And we can use this whether we've optimized the portfolio or not. So it's also available to participants in the Truc Diversification program as an evaluation tool for evaluating prospect portfolios or prospect accounts. Here we're looking at the different touch points of a diversification optimization process and comparing that to other touch points and other processes. So we're using like a passive index investing as sort of the null hypothesis. It's not really adding, it's not really subtracting. It's just sort of the null hypothesis. Do-it-yourself investing tends to be even worse than just the buy and hold investing. You can look at, I think Dalbar is the most, famous of the studies. It shows, due to the, behavioral effects of individual investors that are not, well, trained and experienced in these things, they tend to, buy high and sell low. And even though maybe the index is making some returns, they might be losing money. Definitely strong reasons to employ a financial advisor, and have them keep you from doing stupid things. So traditional optimization is a step ahead of passive index investing. You can see for yourself and sort of study this slide what the individual benefits are. But diversification optimization is able to integrate a lot more quant-oriented, sustainable edges, and that's what we think of this. We think of each one of these little things as being an edge. And we've done our best to quantify the expected return advantages of those edges. They're frankly very challenging to quantify. Some we could pull hard numbers on, and others are more estimated. But we left off putting an actual range on this because I didn't want everyone thinking that just because you use diversification optimization you get somewhat X%. But I think the proportionality here is right and reasonable. And this is the reason why is this list of things that have been done to create systematic, sustainable performance edges. This slide is a high-level overview of a very extensive research project that we executed in collaboration with Standard & Poor's based on optimizing the Standard & Poor's 500. We do have a sort of a peer review grade, 30-some page paper about how this how this product came together. It's our most complete and rigorous analysis and proof source as to the performance efficacy of diversification optimization, and we can make that available. When you look at this from a kind of high level perspective, you see it certainly does track pretty well. The research piece is based on optimizing the S&P 500. That did mean investing in all 500 of the stocks, just reweighting them, creating a diversification weighted version of that product, which we could do for just about any kind of index, just utilizing the diversification weighting instead of cap weighting, or instead of equally weighting, or whatever weighting approach. We think we could pick up some incremental alpha in doing that. You can see though it's dragged a little bit through first several years in its existence. Pretty strong bull market. Diversification slightly underperformed market cap in that period, but ever since 2000 and 2001, it's been edging ahead pretty consistently. And see, for the decade ending 2010, it's basically the lost decade. We were an incremental 799 basis points of annual performance in excess of benchmark. And that's investing in the exact same stocks, just in the different numbers. So what we learned from this research is really the consistency of the approach, and the diversification was working not just to protect against losses. We trimmed losses here, but we frankly really geared the research to outperform. But the outperformance, came really during sideways markets, which is what we saw for a good chunk of this period. And we got less risk by any statistic. Full sample, all 15 years, we were I believe 499 incremental basis points over the index. Really just a pretty vastly different product, superior product. We can make this exact product available in a managed account. We managed this by optimizing within each sector, and then we took rolled up each sector and optimized the sectors. And we did see consistent alpha pickup basically every time we get to run the optimization. So for larger portfolios, like in this case 500, it's exactly the right strategy to do with our technology. This is a pretty amazing proof statement as to the performance benefits of diversification optimization across full market cycle, bear markets or sideways markets. These represent different weighting schemes. Efficient index is essentially like a type of mean variance optimization. There's minimum volatility, which gained a lot of assets in the last year or two. Well, you can see what how that's done. Fundamentally weighted, based on trying to put assets more proportionate to their true sort of market impact weight. Equally weighting, market cap weighting, which is what most stock market indices are, and then diversification weighted. Diversification weighted is what we call the product of diversification optimization. It's the weighting approach that it builds. So all of these different weighting approaches are applied to the same investments over the same time period. Essentially the S&P 500. You can see from an annual return perspective, diversification weighting those assets, and investing in all 500 of those assets, not cherry picking it somehow, but investing in all 500 of those assets based on a 100% rules based systematic approach, yielded 3.3% better than the next nearest indices, and 8.9% better than the actual S&P 500 for the same time period. Interesting to note that market cap weighting, despite its massive prevalence, is far and away the worst thing to do. You could do considerably better just by equally weighting the portfolio, for example. Anyway, I think it's also a testament of proof that you don't need more risk to get more return. Our process produced not just the most return, but it had the least standard deviation. And more importantly, because we don't care too much about standard deviation, it also had the least semi-deviation, which is really just the downside volatility. So it's going to be more closely correlated towards losing money, and far and away had again the strongest values there. So this is all a research paper called Truc Diversification applied to equity index construction. It's a pretty rigorous paper, about 30 some pages, and if you want to drill into that, you can request that from your counterpart at Gravity Capital Partners. Just a collaborating research piece. The first one was based on optimizing an all equity portfolio. We want to see if we would also have similar success across asset classes. We figured we would probably do the same, if not better, across asset classes, because there'd be more potential for diversification. And really, we did about the same. I don't know the exact numbers, but it was 700 to 800 incremental over benchmark annually for the sample period. And all these research is based on a walk forward out of sample analysis, and been rigorously scrubbed for any kind of biases within the research project. You're welcome to any kind of documentation or papers on these. So we do see the incremental performance over stock bond blend 50-50. This project is investing in it was just the cheapest fund from each of the Lipper Global Investment Classification categories that had a 10-year life, and ran all those through the process, reconstituted and reoptimized on a semi-annual basis. Didn't rebalance, so there might be a little more to pick up, but I think we did succeed in proving that the process works there across asset classes, especially since we didn't have any real performance selection criteria in our selection process when we picked those investments, because we just picked them based on they lived for 10 years and they were the cheapest. So it's not like we worked hard at trying to cheat to find great investments or what have you. We just liked Lipper's global classification scheme that has a pretty granular approach. So we know that following that classification scheme would offer the potential for pretty strong diversification. So looking at diversification from a modern portfolio theory view, and I'm going to talk about mean variance optimization specifically here. Now, mean variance optimization was a great step towards getting diversification. And Markowitz told me that there's probably about $1.5 trillion now of dollars across the world, out of about 100 trillion that's wealth management money. that's being optimized. And there's a benefit to this optimization, that you get some benefit of diversification. The thing is, all of that diversification benefit gets channeled through this bottleneck called. Okay, so by focusing the optimization process on diversification, we're seemingly able to exploit some market inefficiencies, and really gain stronger performance by actually reducing the losses that are taken in any kind of down or bear market. So in the old school way of thinking, that's more performance with less risk, and that's really what the all elusive free lunch is really about. Thank you.